So welcome back, guys, to our weekly live event, actually bi-weekly live event. I'm Pascal Corcus, for those who don't know. I have an accounting firm, insurance agency, mortgage company, as well as an investment firm. So I'm here to answer any financial questions that you guys have. And this week we're going to be talking about big news about Zillow and Better.com laying off hundreds of employees in the last few months. So I'm going to give a minute for everybody kind of to hop on and to join our live event. So how's everybody doing? Hope your week's been great and it's been productive. We're getting really close to Christmas and New Year's, so there's a lot to kind of get done before the end of the year. And it's kind of like that last push for the end of the year to make something happen. So personally, me, the last few months, I've been really focusing on trying to get more deals before the year ends, because as the year comes to an end, it's a lot harder to get appraisals and things through the bank to close different investment opportunities. So it's really important to kind of try to get as much done as possible to get it done this year and to get the tax benefits. Because if you make the right investments, you can also get tax write-offs. So I've been really trying to push to find some quality additional products to bring to my clients. Last minute, we had like over $5 million offered to us to help find investments for people, and we've been able to help some people, and others we were not. Again, it's really important to plan your tax strategy ahead of time so you don't run into the end of year problem of finding out that you owe $900,000 in taxes to the IRS, and you're looking for different ways to invest to reduce your tax bill. So great opportunity, but plan ahead. All right, we're going to give it about one more minute, and then we're going to kind of jump into the conversation of what happened this last week and last month with Zillow.
Got one question if you want to take a quick one while we wait for everybody to come in.
Sure.
Heartthrob Rob says, if I have a property that is subdividable, should I subdivide and keep the tenants in it? It has access from both areas of the property.
So the question is, there's a difference between subdividing a lot and subdividing a building. Subdividing a lot, yeah, if you want to do that, it's sometimes a good idea to do that and sell the other lot off. You have different options there. If you're talking about subdividing a building, you having the ability to physically be able to do it is different than for you to have the legal ability to do it. So you can do what you want with your property, but understand that if it's not permitted, you're not going to get much upside when you sell the property. You can't advertise, say, a duplex if it's legally a single-family home. So just kind of keep that in mind. It's really important to, I've seen many people do things like that. And people think, oh, cash flow is really important, which it is. But it's also important to gain equity in what you're doing. So if you're not following standards and procedures, if you're not pulling permits, and you have a bunch of unconforming units, it's going to be very difficult to get top dollar when you're selling the property, which is where you're going to make your wealth, is building your equity. So remember, always pull permits and to get the highest resale value.
You want to take more questions or you want to do your thing first?
Go ahead.
All right, next question. How do you calculate depreciation on a multifamily investment?
How do you calculate depreciation on a multifamily investment? So basic is 28 and a half years for a 1 to 4 family property. If it's over 4 family property, you're considered commercial, so you can have over a 40-year depreciation on the buildings. So that's IRS standard. There's additional ways you can cut up your property for faster depreciation. So like paint, flooring, carpet, drywall, cabinets. You can actually have AC units, a different useful life for each product, so it can be on a more of an accelerated depreciation. So it depends on the building and the product that you're actually installing into the building. And if you have a good accountant, you'll be able to get it, set it up in such a way where you're going to have everything in the lower depreciation years. So he's going to make sure to extract the items that are 5-year items, so you can try to bonus depreciate them year one.
Next question. Would you rather buy an insurance agency or a great located property, and you only have money to do one?
Mm-hmm. If I am looking to build wealth, I would buy a great property. So let's be conscious, right? If I'm buying a great insurance agency, I'm saying I have $1 million. So I have $1 million. Am I going to put it down on an insurance agency, which is roughly, say, 30% down payment, and getting a commercial loan? That's going to bring me really good cash flow, and I'm going to be able to pay down the mortgage quickly with the loan, because most loans are 10 years. And I'll have an agency with the cash flow, but it's not going to truly grow much in the sense of valuation increasing. Compared to a great property, will have less cash flow per month compared to how much an insurance agency can generate. But that property is also a lot less work, a lot less risk, and property appreciation in a good property can appreciate faster than an insurance agency. And with a property, you can put down, say, 20 to 25%. So your return on cash can be better. So in that example, you're putting down 20% on a $5 million property, it's $100 million. So you're going to get the ability to grow your wealth can be faster with a really high quality piece of property. The cash flow is lower. So do you want cash flow? Do you want wealth? All right. So in the last few months, we've had 2 major tech, finance, and real estate companies lay off hundreds of employees. The first one that we've seen 2 months ago was Zillow. Zillow laid off hundreds of employees and abandoned their division of buying homes directly from consumers. So if you didn't know the story, I'll step back some more. Zillow went from just being a website that showed real estate prices, sales, history. You can do a lot of searching on Zillow. Now, the progression of Zillow then started to advertise, give suggestions for you not to contact the listing agent, but they actually pushed you to contact a buyer's agent so they can get compensation on that. They then started adding mortgage brokers to it. And from there, they then started to have Zillow agents themselves. So meaning Zillow had agents that worked for them directly. I particularly thought that was a conflict of interest because you're making people pay to be on your app, and then you're also providing your own agents. I thought that was a conflict of interest. But the next thing that they did was they created a fund where they were starting to buy properties from people directly. And they were paying a significant amount of money for a property. And they made it very hard for the average person to buy a house in a neighborhood because they were paying so much over the common price in that neighborhood. And if you guys really know valuations of real estate, the Zillow price is normally wrong. It's really wrong. Like most real estate agents, if a client went and said, hey, the Zillow says my house is worth this much, I want this much. And normally the issue is the real estate agent has to tell the person the truth, which is your house is not worth as much as the Zestimate. It's usually off. It's including properties that should not be included in the estimate. Well, Zillow was buying property on their Zestimate price, and they were paying roughly 20% over price. They saw that they were buying a lot of properties and paying too much money, and that they were losing money on this deal. So what do? They double down and they buy more property and overpay for them even more, thinking that they probably figured out a solution. Well, they didn't. And in that process, they actually lost investors a ton of money. Then what do? They actually called back the original homeowners and offered them to the opportunity to buy back their house for $20,000 to $50,000 less than what they sold it to Zillow. And a lot of people did choose to buy back at that discounted price. So good for them, right? Zillow didn't realize and didn't want to accept the fact that local real estate agents that know their market, that's why I emphasize study your market, actually have a high quality skill that they're bringing to the market. A computer and someone from 5,000 miles away cannot accurately say what a property is worth, street by street, neighborhood by neighborhood, school district by school district. Data is great, but there's a big factor that walking the street and knowing the heartbeat of a neighborhood can provide. And because they bit off more than they could chew and thought that they could do more than they can, they lost billions of dollars and fired hundreds of people. Next company that's come into a situation recently is Better.com. Better.com is a mortgage company that's only online, and you submit your documents online to get a mortgage, right? It's a simple concept. And they have all these mortgage brokers as basically phone sales. And they recently fired 900 employees. The CEO had a Zoom call with 900 employees, and anyone that was on the Zoom call was basically being notified that they're going to be fired. So in that process, he actually got a lot of heat for that. And let me see here. All right. So he got a lot of heat for firing 900 people at one shot. It was considered cold the way he did it. Could have been done better. But the point that I'm trying to bring with Better.com is this is another company that thinks that the mortgage business can be done from thousands of miles away from someone that doesn't know the client. Knowing a person to provide someone with a mortgage, you really got to get to know the person. You got to talk to them. Everyone has this idea of what they should get, and this preconceived idea based off of these things they heard online. Now, there's a lot of good information online, but what I want to say is not all information is good for you. And these phone sale mortgage brokers did not know their client. They were just trying to peddle through a lot of mortgages, and in that process, not truly give the consumer what they need. And it showed because this company that offers supposedly fair rates didn't do very well. Those 900 employees got let go because of production. Now, this company, like Zillow, thinks that if they try to squeeze margins and bring things in-house, that alone will be able to offer the client more. By saving them 1 or 2%, it will be more to the client's benefit. But the reality is, when you have a high-quality real estate agent, you have a high-quality mortgage broker, high-quality insurance agent, these people are bringing you valuable information. And this is an education process that someone that's just trying to pump through a real estate deal and just make a commission is not providing you. in the business of real estate, insurance, mortgages, agents, a mistake on the business side can cost you a whole year's profitability. So when you're floating on thin margins and on high production, and you don't know the people, you don't have relationships, it is easy for you to make a mistake with that person because you didn't provide them the best service and didn't give them possibly the best thing for them. Along the way, you don't have a good relationship and they start losing a lot of money. I've said it before, there is lots of benefits in technology, but the technology cannot replace what the human is bringing to another human. It needs to come together in a fashion where it's expanding the human experience, not reducing it. So I see that this is hopefully going to be a wake-up call for these tech companies. But if not, this is going to be more ways that they're going to lose money and more ways that they're going to convince investors to try something that's only going to fail. Kind of like fiat currency. So that was my talk for today, and I'm going to open it up to the Q&A section for anyone who has any questions regarding what we spoke about today or any other topic. So we have one question here from George, and he says, "Hey Pascal, if you would buy a triple net property, which industry would you choose? What are some brand examples? Would you look at any other stats?" So I'm interested in mobile homes, storage unit, warehouses, apartment complexes, small strip plazas, or repurpose, or something that is cheap enough to repurpose and provide value in the transition. So meaning buying a mall for a low enough price and repurposing it to a neighborhood center. So portions of the mall would be apartment complex, portion of the mall would be storage facilities, another portion would have a bunch of small businesses, like very small 1,000 square foot, 2,000 square foot businesses that cannot compete with Amazon. Amazon can't compete with them because they're very niche specific to the area. So those are the things that I would be focusing on if I was going to go into that. Go focus on something like that. Otherwise, downtown core real estate, multifamily is going to be on fire for the next 15 years, in my opinion. I called that trend like 15 years ago, and I think it's even more important now going forward the next 15 years. So, good question, George. And thanks for smashing the like button, guys. I appreciate it. Do you have anybody on IG or TikTok? Well, IG always has like a lot of questions. So.
Not yet. There's an interesting news that came out that possibly Evergrande, Chinese real estate company, is gonna default. What do you think that will affect? How do you think that will affect possibly real estate or businesses in general here in the United States?
So a company like, so I'll step back and explain a little bit more about Evergrande. Evergrande is one of the largest real estate investment companies in China. And basically what they did is they took people's money to build real estate and did not finish everything that they said they were going to build. They started doing many projects and not using the money the best way possible to earn a good return. So a lot of people are going to end up losing their money in China that were paid for properties. In addition to that, there is a lot of investors internationally that invested with Evergrande to build out properties in China. That was a way where people can have the exposure of the growth of the Chinese market. Now, if they do default, all of those investors are going to lose money. And we're talking about billions of dollars, right? A significant amount of money. How that's going to affect America, one, it would reposition or people will relook at their investments in larger areas, meaning like LA, New York, the larger developments, because they're going to be concerned about how are those investments, those they think it's guaranteed, but sometimes they might realize that they're somewhat speculative investments on these low cap rate investments. At the same time, I believe it's going to help change the view of certain investors to kind of take a step back into investing into their own country, where they're going to step back and say, well, we thought investing in China was growth, was safe, especially in the real estate sector, and it's not. We just lost all of our money. So I think that can be beneficial to America by bringing back a lot of these investments. Now, in the sense of the benefit is, instead of compared to say '08, these aren't currently there shows no sign that they are their financial and banking system is not intertwined with ours. So that is going to be a good thing, since that's what caused the '08 crisis, is the whole financial system was intertwined. So the last point I'm going to say is, as long as we don't see what am I trying to say? Because I'm trying to say it as simple as possible. As long as we don't see China and the Chinese system have more defaults, as long as they can cap this and hold it just into that one company, this one real estate sector, they don't make it a financial problem in the sense of rolling off into other financial sectors, it'll be fine. But if they take this one company's real estate holdings and their one issue and let it affect other financial sectors inside of China, it's going to exacerbate the issue that we're having right now with getting product. It'll make it even worse. People will go from these cities, and they're going to go back to the field. They're going to go back with their relatives, and they're not going to want to produce more goods. It's going to cause us to have even a worse manufacturing problem than we do right now. And what we have now is pretty bad as is. So that's kind of where really my concern is hopefully it doesn't affect any other sector that would affect the trade.
No questions yet from Instagram or anywhere else, but that's
strange, because normally on IG it's like usually
not yet
a lot.
Well, here's another thing that happened this week. The Congress approved an increase on the debt ceiling.
Mm-hmm.
How do you think that'll affect? Well, coupled with the Fed wanting to taper apparently money printing or
Yes.
something like that. So how do those two things together? How will that impact next year? So
the debt ceiling has been raised, I think, like 44 times, and it's almost like expected. I did not think of any scenario where they did not raise the debt ceiling. Now, once the change happens in Congress and the Senate, and they, because there's going to be an election coming soon, so that is going to question on how much more printing we're going to have going forward. But if we're coupling that with the tapering, we got to remember on the tapering part, they're not saying they're not going to print any more money. We have to understand that they're printing a record high amount of money. And as of November, they said we're going to reduce the amount about, I think, 5%, and then another 5% in December, and they're going to continue to reduce it about 5% every year. It's not that they're going to, or every month. They're not going to stop. They're still printing a record amount of money. They're just going to print less than they were, trying to bring it back to a normalized amount. If they keep it at this small pace level, I think it's going to be conservative enough for them to realize that they cannot go back to normal, that they've done the damage that the system is now drugged with this cheap money. Our financial system, the global financial system, is drugged with this cheap money. So if they start tapering, start reducing this out of the system, it's gonna have a withdrawal effect from reducing this, and reducing the amount of capital out there, reducing the cheap money out there, and they're gonna have to go back and basically reduce interest rates, print more money, and just make money as cheap as possible. The way the system's set up, in my opinion, they can never really pull back. They're going to try, but it's not going to work. They're going to have to keep on dropping interest over time. I believe we're going to copy a Japan, Germany, where else? Switzerland, Sweden, where they have like a 50-year, 100-year mortgage, a 1% interest rate mortgage. I think long term we're gonna head in that trend.
Nano420 asks, what do you think about real estate in the metaverse?
So it's interesting because I think real estate in the metaverse is going to be worth something in the future. It's hard to say which one of the current companies, I think there's about 5 big ones right now, that are going to be the winners. So it's definitely interesting to see what's going to happen, but it's hard to say which one of the 5 are going to win or how that's going to truly play out. But I think there is going to be a winner in this space, right? Winner take most concept. So it's interesting to see what happens. I got to hear a question from Partik, and he says, "Hey Pascal, would you invest in real estate vehicle or invest in yourself to attain skills? Question pertains to a 2-year or less cycle. I'm brand new to real estate, but being an investor seems easier. Vehicle as a fund that offers ROI instead of doing all the work." So, So now, if you're a real estate investor, so he says, why I'm thinking is this. He said real estate investor. One, if you invest in a fund that is not like a syndication, but if you invest, like say you invested in a fund, a real estate fund that's on the stock market, you're not really a real estate investor per se. You are investing, but you're not a real estate investor. Now, if you're doing, say, a syndication, you're a real estate investor. If you are buying a property on your own and you have, a number of duplexes, quadplexes, you're a real estate investor. But just buying into a fund on the stock market that owns real estate, you're not a real estate investor, right? So to say it just seems a lot easier, that's one part of it. So now, to answer the part of if you're investing in a real estate investment or in yourself, it's a lot easier to invest in real estate. Yeah, it is quote unquote easier to give your money to someone and have them make a return for you. But when you invest in yourself, the idea is this: you're going to get better at what you're doing, so you will be able to pick better funds, better syndicators. You'll be able to do a better job at picking who you're going to invest with. And that's just one example of how you have to better your skills. Today, I've spent my whole life in this game, financial services, real estate. I'm still myself focusing on growing my skill set to become better. Because even though I'm doing well and I'm pulling very, very good returns with my investments, I want to do even better. So you should have the idea of being a lifelong learner and enjoy the process of learning and growing. Sometimes it's not that much fun and it's not as easy as just investing, but long term, an investment in yourself is the highest ROI. Just so at certain times the camera will turn off and stop recording. Normally, I think I'm every 20 minutes. So you don't have to press the record button again to start recording again. Partik, I hope that helped.
Guys, have any questions? Just put it in the comment section.
So every 2 weeks, we go live and answer any questions around finance, tax, accounting, mortgages, real estate investing, crypto, and we're here to basically offer help any way possible to help you grow your knowledge, because that's, again, the most important thing, best ROI. And whoever's on my what is it called? Newsletter? Yeah, my newsletter. We actually send out an email every week to give them more direct access information of what's hot, trending, what's happening, and things to be keep your eyes on. So our newsletter, if you send us a message, we'll be able to put you on that list to get the newsletter as well. And yeah, a lot of good things coming for 2022. We're actually coming out with a crypto fund as well. We had a real estate fund, we had a natural gas fund, and now we're going to be having 2 years of work is finally coming to fruition. We're going to be coming out with our cryptocurrency fund, so it's super exciting. We're getting great opportunities to be able to buy Bitcoin at wholesale pricing and be able to offer yields for staking coins all in one fund. So it's really exciting to finally get to this point.
Yeah, Eric is asking, what's the path to become like a syndicate investor, to be in those kind of deals?
So there's two. There's one that you'll hear if you hear advertisements for real estate syndications and investments, like a lot of things that say Grant Cardone does or any of the large syndicate investors. They're going to require that you be accredited. Accredited means you have a net worth of $1 million, not including your home, or you're making over $200,000 a year for the last 2 years, or you can prove that you're going to be making that much money for the foreseeable future. Basically, either you have a lot of money or you make a lot of money. Otherwise, if you want to be an investor into syndications, you would have to have the friends and family connection. For example, I have clients that are my accounting clients. So if they don't have enough, if they don't meet those requirements of being a accredited investor, they can still invest with me since they have we have a pre-existing relationship. So if you don't have the high dollar, income or wealth, you can still build a relationship with syndicators and have the opportunity to invest with them through the personal relationship.
Proc9 Saxon asks, thoughts on buying another property in the state of California now or wait? I feel it's been crazy busy abnormally this time of year.
So this last half of the year has been pretty crazy because a lot of people are concerned about the tax implications of 2022. They don't know what Biden's going to do. So they're trying to make sure that they get their deals sold, that they make their moves this year because they don't know what holds for next year. People don't know if interest rates are going to go up, so they're trying to lock in lower interest rates. People don't know if taxes are going to go up, so that's going to cause a lot of people to not sell. So some people think, taxes are going to go up. It's going to make people, it's going to cause an issue and crash the market. People think that interest rates are going to go up and it's going to cause an issue. It's going to crash the market. I actually think the opposite. And again, I think that's why a lot of the sales are happening this year, but let's follow through. If taxes go up on a real estate transaction, on a sale, if they get rid of the 1031 exchange, hypothetically, because people are afraid that might happen, what would end up happening is that people that own the real estate they do today will have very little reasoning to even sell. Because real estate investors, they invest in real estate because they don't have to pay a lot of taxes, or they can defer their taxes through a 1031 into the next field. But if you've owned a property and you bought it at $1 million, and now it's worth $5 million, and you went from a long-term capital gains of 20% to a long-term capital gains of 40%, and you can't 1031 exchange, you basically removed any reason that they're going to want to sell. So it's going to have the people who own real estate hold it even harder, limiting the supply, causing prices to go up. Now you say interest rates. Now there's an inverse relationship. As interest rates go up, real estate prices normally go down. As interest rates go down, real estate prices normally go up. Now, if you see how many people got very low rates today, what's going to cause, even though increasing interest rates will have a negative effect to cause real estate prices to have a depression, because higher interest rates means larger mortgage. But on the other hand, if someone has a 3% or less interest rate loan, it's going to make it less desirable for them to sell their house at a lower price and then buy a new house, at a higher interest rate. After running their calculations, seeing their new mortgage, seeing the new taxes, seeing all that new information, they're going to come to the decision that, okay, where I live today is a better payment than I will, say, if I downsized. My payment might even be higher because that's a higher interest rate. That's the taxes are going to be higher. All these other factors. So there is the two negative things that could happen to cause real estate prices to maybe go down are actually reasons also why it would actually keep the prices up as well.
All right. Mac Jones asks, hey Pascal, why is the property value in California so high for a 900 square foot shack looking house?
So there's a lot of people in California have money and they're putting their money somewhere. They want to put somewhere, particularly they want to put it somewhere safe. And historically speaking, real estate has been safe. I know we went through 2008. I know people have that in the back of their mind. But historically speaking, real estate is safe. It doesn't normally go down unless there's a financial banking crisis. So that's one. Two, rents. Rents are very high. So there's a correlation between rent price and property value. So just think about it. If someone has a lot of money and they can buy a property, pay cash for it, make 5% on their money, and then have the property appreciate at 5 to 10% a year, that's a 15% IRR return on a all cash purchase. And that's a good deal for them. So that's also why real estate is a good deal for us.
Marat01 asks, hello guys, I filled the application for the course and I haven't got a response on how long it takes to respond. I think he means course.
All right. Send us a DM on IG and we will have Hannah look into it for you.
Nano420 asks, if you depreciate an investment property and you sell the property, do you have to pay back the depreciation plus the taxes on the property?
I don't depreciation plus the tax. So I don't understand exactly what the question is, but I will answer regarding the topic. One, if you own a property for 30 years, I'll give you a simple example. If you own a property for 30 years and you depreciated it over the 30 years, and at the end of the 30 years, you bought it for $100,000, you sold it for $1 million, you're going to owe tax on the $1 million. You're going to own long-term capital gains on that gain. You can do a 1031 exchange and avoid possibly all of the tax and defer to the next deal. If you bought a property this year and you wrote off a 5-year useful life item, say you wrote off all the carpet and you wrote off all year one, but it's a 5-year life. When you sell it a year later, you actually have to do a recapture on the 4 years that's remaining on the carpet. That recapture as an earned income, earned income tax level, not as a long-term capital gain level. So yes, if you're doing depreciation, you must be careful. You have to have a financial specialist, an accountant, an advisor, and your accountant and tax preparer isn't the same person that's giving you advice. It can be two separate people, right? So that is following your strategy, because if you do that, you can end up paying income tax on the other 4 years that's being recaptured on the carpet. And that could literally eat up most of your profit. I've actually had that happen where a person sold a gas station, in the process had a ton of recapture. They did not plan accordingly and ate up most of the profit that they got on the sale of the gas station in Plaza. So it was a bad idea. And when I reviewed the property, it was actually a really good property. They shouldn't have sold it. They had no true, real rationale to sell it. They just, well, I didn't feel like managing it. Well, why are you managing such a large property? Get a property manager, and you can avoid all the headache that that was just created. So, get an advisor. They'll give you good advice, and make sure you're making a smart decision for your money.
Mac Jones asks, "Hey Pascal, if I buy a new home, do I escrow or not escrow?"
I normally don't escrow. I personally do not like escrow. One, you have to be good with one. Just remember, if you're not going to escrow, you do have to be good with your money. You have to remember that your property taxes come due. You got to pay it. Your home insurance came due. You have to pay it. Now, easy enough. It's only one time a year you're going to pay your property tax. It's only one time a year you're going to pay your home insurance. But the reason is this: I have, between property taxes and insurance, I probably have I think easy $150,000 a year. Why am I going to give the bank $150,000 to hold? Just giving me no interest, nothing. And normally they take 25% more than the actual amount owed in reserves just in case it goes up. So you're looking at, somewhere almost like $190,000 a year that they're going to be holding of my money. No interest, no gain. I'd rather hold that $190,000 and use it as I see fit. And in that sense, when you have that extra $190,000, there's less money that you're going to have to take out as debt. So I prefer keeping it. We got 4 more minutes, so what we can do is we can go into rapid fire question, guys. So we got about 4 more minutes on our live event. So definitely send in all your questions. I want to answer them as fast as possible, and I'll try to spit them rapid fire so we can get as many done as possible.
Do you think a home equity line of credit is better than a cash out refi? What do you think? Which one will save me more money in the long run?
So don't think about saving money. Think about making money, and think about reducing risk. It's saving money is not reducing risk, not making money. So I would cash out refi to 70 to 80% loan to value, then get a home equity line of credit to take out the rest of the money. And take that money and make that money go to work for you. Because if you don't do that, you're going to end up working the rest of your life. Until you have your money working for you, you're always going to be working for your money.
If you get a loan to buy a fourplex property, how do you know what is good value?
So that's a problem. You need to know your value. You need to study your market. So you should be looking at all the different multi-units in the area and know, in this neighborhood, in a bad condition, it's worth this much. In a good condition, it's worth this much. In a bad condition, I can get this much rent. In a good condition, I can get this much rent. Right now, I'm paying $800,000 for a 5-plex, and the rents are between $400 to $700 a month. I'm then going to be remodeling the properties, probably spending around $50,000 per unit on the remodel. In that $250,000 investment, $800,000 purchase, I'm in for $1,050,000. When I'm finished, the rents for the 1-bedroom are going to be about $1,800. From $400 to $700 to around $1,800 a unit. So, as you can see, There's lots of return in this area if you buy the property right. Same thing for you. You need to know, how much should I pay for this property in that condition? What is the rent? And can I make a profit on the rent, and can I make a profit on the appreciation? And if the answer is yes to both, then it could be a good deal. Looks like we got time for probably 2 more questions.
Should I buy real estate in the metaverse?
If you have money to spend, yeah, you can do that. I buy NFTs. I buy a lot of things in the crypto space. I believe metaverse, crypto, and Web 3.0 are all functioning together to build out the future. So yeah, if you have money to spend, it's fair to say you can spend some money in those spaces.
What's your favorite? Proc9 Saxon asks, what's your favorite real estate app to follow to be top of your market? Obviously, may not be necessary if you're dialed in with brokers and agents, but for someone who doesn't know, how do they look into it?
So you should look everywhere. I have agents and I have apps and I have it all. So you should use Zillow. You should use Realtor.com or Zillow app, Realtor app, LoopNet app, Crexi app. So each one has its own benefits, and there's actually some properties on Realtor.com you'll not find on Zillow. Why? I don't know. There's also commercial properties. Some brokers in the commercial space, they will only list on certain websites. So you might find something on Crexi that you won't find on LoopNet. So there is opportunities when you're looking everywhere.
Gustavo Brown asks, well, we already went through this topic, but I guess he wasn't here. Do you expect a pullback in the housing market because of the real estate crisis in China?
There's too many factors. Again, unless we have a financial banking crisis, I'm going to say no. Too many people want to buy a house. It's not the issue that less people want to buy it. Right now, they're saying next year the inflation rate or the appreciation rate of houses is not going to be as aggressive this year. This year in the Tampa market, it's 25%. Next year, it's supposed to be around 20 to 22%. Nationwide, it's supposed to go down roughly 5% compared to this year. Where the issue that I'm seeing, or what's the factor that's not being communicated clearly, is it's not there's less people that want to buy houses now than were before. It's that the houses that people want to buy aren't available. The level, there's a massive amount of people that want to buy property that cannot buy property at the current prices. So they're still there ready to buy. If there was some type of pullback and there's more homes that were affordable to them, they're going to swallow all that supply up. I mean, we have 3 million housing units short, and we're basically building, we're negative 300 every year on the quantity that's being built, meaning next year we'll have actually 300,000 housing units short. Following year, we're going to have 3.6 million housing units short. It's only getting worse each year. So if we do have some type of issue in the market, all of those houses are going to be absorbed very, very fast. So I don't see housing prices that go down hard. So I see 25% last year, right? I'm talking about my market, 25% in 2021. 2022, I'm going to say it's probably going to be around 20. 2023, let's just say it's 15%. 2024 is a questionable year. Are we going to have the 2023-2024 year? Are we going to have a 10% increase? Or are we going to have a flat? Or are we going to have a 10% drop? Those are 3 valid options on that time period. because by that time period, most of the money that was been spent into the system is going to be spent. If we don't have our financial situation fixed, we could have a pullback, but the pullback is not going to cause an '08 style. And even if in 2023, 2024, we do have a 20% pullback, 2021 was 25% increase, 2022 was additional 20, 2023 was 15, 2024 is 10. So if you have a 20% pullback, you're still paying a higher price than 2 years prior. So yeah, you can wait, but 4 years from now, there's a very good likelihood that we are about, 45% higher than we are today. Now you're going to say, that's ridiculous, that's too much, and so on. But when you print 25% additional money, like we increased the total amount of money in our system by 25%. That's going to have a huge effect on the whole system. And every time the government makes money, right, they fabricate additional money. The banking system, when it goes through the system and then it goes to the banks, the bank is allowed to loan 7 to 10 times that amount of money in that account. So we didn't just create potentially 25% more money, right? We potentially created 7 to 10 times that amount. So we have to be very careful about the hyperinflation that could be coming. So again, the downside in the next 2, 3, 4 years is not looking to be much. I believe this was going to happen. Like this is what I think is going to happen. Where next year, let's talk about the stock market. Let's just say the market's at say $37,000. At the end of the year, we could be at $37,000. We had ups and downs throughout the year, but you're still at $37,000 at the end of the year. And everyone's like, oh, we broke even, or we're up $1,000, we're $38,000. In dollars, yes, it's the same. But if we look at it nominally means inflation adjusted. Nominally means, yeah, you have $37,000 in the beginning of the year is $37,000, but that money can't buy as much as what it did the year prior. So you're actually, you lost wealth, you lost purchase power, you're more poor. So I believe because of the hyperinflation, we're not going to realize that even if the price of something goes up 10%, you're still more poor than the year prior because your money lost more than 10% in purchasing power. So I believe if we're going to fall, we're going to fall forward. We're going to fall sideways. We're not going to go down in pricing. It's because of the inflation. You're just every year going to have more money. It's just the money can't buy anything. The cost of goods will be so high.
How can we save tax on buying a property?
Okay, so last question. How can we save tax on buying a property? So that doesn't make a lot of sense because when you buy a property, you're not really paying tax. You're paying tax stamps on the mortgage. When you buy a property, so if you're saying how can you get tax write-offs from buying a property? If you're buying a property that is not your primary residence, if it's an investment, when you invest in real estate, you can actually depreciate the asset. You can depreciate parts of the asset faster than other parts. So you could, if done properly, if you bought a $5 million property, you put down $1 million as your down payment, you could potentially depreciate the property $1 million, $1.5 million year one. So on your tax return, you're showing $1.5 million loss. So how you do that is you go to a good accounting firm, you get a good strategist, and they'll help you through the process of doing that and being able to reduce your tax bill through your investment.
Last question. Is it a good time to buy commercial office real estate now, or is the market still declining in that area?
I think it's going to be market specific, right? Real estate is literally city by city level. If I bought office space in Newport Richie, am I blurry? I look a little blurry. The stuff behind me is clear, but I'm blurry.
Yeah, it does that sometimes. It's on autofocus, so we're trying to manual focus it, but you keep moving around.
So, to answer your question, that's better. So to answer your question, if you buy an office space, say in Newport Richie, there's not demand for office space in Newport Richie. Now, if you want to have office space in St. Pete, there's extremely high demand for office space. Kathy Woods is moving her office from New York City to St. Pete. So it's city dependent, location dependent. Do I think I like buying properties when they are distressed? So if you can find a distressed property, office building in a great area, yeah, it could be an amazing investment, amazing return. Because if you wait until things stabilize too much, prices are also going to stabilize and the profitability is going to disappear.
Opportunity zones, do they still exist? Or
They
is
do.
it gone? Okay.
They do. They haven't been as good as we had hoped, but they exist. So, guys, great talking to you. Enjoy our bi-weekly event. Next time will be in 2 weeks on Wednesday at 10 p.m. Bring your questions, bring your friends. As we learn together, we all grow together. Have an all boats ride concept, meaning if we all grow together, we all can make money, we can all benefit. God bless you guys, and see you next time.